Here is a number that should honestly make you a little angry. The single biggest expense of your entire life is not your house, it is not your car, and it is not even all the lattes the internet keeps blaming you for. It is tax. Add up everything you will hand over to the government across a working lifetime, and it dwarfs almost everything else you will ever buy. And here's the part nobody tells you. A huge chunk of that bill is optional, not in a shady, look-over-your-shoulder kind of way. In a completely legal, the tax code was literally written to reward this kind of way. Today I am going to show you how to keep far more of your own paycheck, starting with the one myth that is quietly costing regular people money every single year. Quick, important note before we dive in. I am Sarah, and I am here to teach you how this stuff actually works, not to give you personal tax or financial advice. I am not your CPA, and I am not your financial advisor. The rules I am about to walk through are United States federal rules for the 2026 tax year, and your situation, your state, and your filing status can change the math in a big way. So treat this as your education, get genuinely smart about it, and then talk to a qualified professional before you make any moves. Deal? Now let us bust that myth. Ask most people how income tax works, and they will tell you something like this. If a raise pushes you into a higher tax bracket, you actually take home less money. I have heard people turn down extra hours over this. I have watched friends agonize over a promotion because they were convinced the bigger title would somehow leave them poorer. It is one of the most expensive myths in personal finance, and it is completely, provably false. Here is the truth. The United States uses a progressive system with 7 marginal rates: 10%, 12%, 22%, 24%, 32%, 35%, and 37%. The key word there is marginal. You are taxed on each next dollar at that bracket's rate. You are never taxed on your whole income at one single rate. Think of it like filling up a set of buckets. The first bucket fills at 10%, and only once it is full does any money spill into the 12% bucket, and so on up the line. Let me make that concrete, because numbers beat theory every time. Say you are single and you earn $70,000. The first thing that happens is the standard deduction. For a single filer in 2026, that is $16,100, and it comes right off the top. So you are not even taxed on $70,000, you are taxed on $53,900. Now we walk up the brackets. The first $12,400 is taxed at 10%, which is $1,240. The next chunk, up to about $50,400, is taxed at 12%, which is roughly $4,560. And the last slice, up to your $53,900, is taxed at 22%, which is about $770. Add those up and your total federal income tax is around $6,570 on a $70,000 salary. That is an effective rate of about 9.4%, not 22%. If you had wrongly assumed your whole salary got taxed at 22%, you would have braced for around $15,400. The real number is less than half of that. Feel that relief for a second. And about that raise, imagine you get a $5,000 bump, taking you to $75,000. Only that new $5,000 gets taxed at the higher 22% rate. That is $1,100 in tax, which means you keep $3,900 of the raise. You did not lose money, not a single cent. You will literally never take home less because of a raise. The only thing that ever happens at a bracket line is that your newest dollars get taxed a little more, while every dollar underneath keeps its lower rate. So if you have ever hesitated on a promotion, a bonus, or a side income because of bracket fear, please let that go right now. More income is always more money in your pocket, full stop. Now that the myth is dead and buried, let us start actually shrinking the bill on purpose, with 3 strategies you can genuinely use. Strategy number 1 is the simplest and most powerful one for the average earner. Pay yourself before the tax man using pre-tax retirement accounts. The 2 big ones are the workplace 401k and the traditional IRA. Here is the magic. When you put money into these accounts, those dollars come out of your income before income tax is calculated. So they lower your taxable income, dollar for dollar, this year. Let me show you. Say you earn $60,000 and you contribute $6,000 a year, which is $500 a month, into a pre-tax account. Now you are only taxed on $54,000, not $60,000. If your top dollars are sitting in that 22% bracket, that move saves you roughly $1,320 in tax this year. And the money you set aside is not gone. It is yours invested, and it grows tax-deferred until you retire. You moved money from the government's pile to your future self's pile, and you got a discount for doing it. How much can you put in? For 2026, the 401k lets you defer up to $24,500 as an employee. If you are 50 or older, you can add an $8,000 catch-up, and there is a special larger catch-up of $11,250 for ages 60 to 63. The traditional IRA lets you contribute $7,500 with an extra $1,000 if you are 50 plus, and it is deductible if you are eligible. And please do not skip this part. If your employer offers a match, that is free, pre-tax money sitting on the table. Leaving it there is like turning down part of your salary. The one trade-off to know: this money is generally locked until age 59 and a half. Pull it early and you typically owe the tax plus a 10% penalty with some exceptions. So fund it with money you can leave alone to grow. Strategy number 2 is the one wealthier people lean on hard, and it is more accessible than you think. Earn through the right structure. Think about how an employee is taxed versus how a business is taxed. As an employee, you earn, then you get taxed, then you spend whatever is left. As a business owner, you earn, then you deduct your legitimate business expenses, and then you only get taxed on the profit that remains. That ordering is everything. So if you have a side hustle or a small business, real costs of running it can come out before tax. Things like a genuine home office, your equipment, your software, business mileage, and so on. You are taxed on what is left after those, not on every dollar that came in. On top of that, there is a powerful break called the QBI deduction, also known as Section 199A. It lets eligible pass-through businesses like a sole proprietorship, an LLC, an S-corp, or a partnership deduct up to 20% of qualified business income. And here is some genuinely good news. That 20% deduction was made permanent by the One Big Beautiful Bill Act back in July of 2025, so it is not some perk that expires next year. For 2026, there is even a minimum $400 deduction if you have at least $1,000 of qualified business income, with phase-in thresholds starting around $75,000 single and $150,000 for joint filers. There is more structure to play with as you grow. An S-corp lets you pay yourself a reasonable salary and then take the rest of the profit as distributions, which can trim your self-employment and payroll tax. A C-corp pays a flat 21% corporate rate, though you have to watch out for double taxation when profits get paid out as dividends. Now, the big caveat, and I really want you to hear this one. This only works if it is a real business with real expenses and, where it applies, a reasonable salary. You cannot just slap an LLC on your hobby and start writing off your vacations. Aggressive games get audited. So if you go this route, build it properly and work with a CPA. Done right, this is one of the most powerful legal levers there is. Quick pause, because we are about to get into my favorite category. If your brain is lighting up right now and you are starting to see your paycheck differently, do me one small favor and hit that subscribe button. We break down money, taxes, and how to actually keep more of yours in plain English every single day. One short video a day and you will be the person at the dinner table who actually understands this stuff. Okay, on to strategy 3. Strategy number 3 is about shielding your gains so the growth is tax-free. The first 2 strategies cut your tax bill today. This one is a gift to your future self. The headliner is the Roth IRA. With a Roth, you put in money you have already paid tax on. It does not lower this year's taxable income, but in exchange, the growth and your qualified withdrawals in retirement are 100% tax-free. Think about that. You could put money in, let it grow for decades, and never pay a dime of tax on all that gain. For 2026, you can contribute $7,500 plus an extra $1,000 if you are 50 or older. There are income limits on contributing directly, and higher earners often use what is called a backdoor Roth to get in, which is exactly the kind of move you want a CPA to set up correctly. And if your workplace plan offers a Roth 401k, that is the very same tax-free idea inside your employer plan. But my absolute favorite account, the one I wish everyone knew about, is the HSA, the Health Savings Account. It is the only account I know of that is triple tax advantaged. Follow this. The money is deductible going in, so it lowers your taxable income today. It grows tax-free while it sits there, and it comes out tax-free when you use it for qualified medical expenses. Deductible in, tax-free growth, tax-free out. 3 tax breaks in one account. For 2026, you can contribute $4,400 if you have self-only coverage, or $8,750 for a family, with an extra $1,000 catch-up if you are 55 or older. The catch is you need an HSA-eligible high-deductible health plan to use it. But if you qualify, this little account is an absolute powerhouse, and a lot of savvy people treat it as a stealth retirement fund. Now, I told you at the top there is a whole legal playbook, and we have really only covered the foundation. So let me rapid fire a few more moves that are out there, just so you know the menu is much bigger than most people realize. First, long-term capital gains. When you hold an investment for more than a year and then sell, the profit is taxed at special lower rates of 0, 15, or 20%, far below ordinary income rates. In 2026, that 0% rate runs up to about $49,450 of taxable income for a single filer, and about $98,900 for joint filers. Yes, 0%. Patience is its own tax strategy. Second, tax loss harvesting. If some investments are down, you can sell them to offset your gains, and you can even use up to $3,000 of those losses against your ordinary income in a single year. You take something that felt like a setback and turn it into a tax break. Third, real estate, which comes with depreciation deductions that can shelter rental income, plus a tool called a 1031 exchange that lets you defer your gains when you roll the money into a like-kind property instead of cashing out. Fourth, the 529 plan, which grows completely tax-free when the money is used for education. Fifth, municipal bonds, where the interest is often free from federal tax, which can make a modest yield surprisingly attractive once you account for the break. And there is still more, from electric vehicle and clean energy credits to smart charitable giving using donor-advised funds and gifts of appreciated stock instead of cash. We are honestly just scratching the surface here, and these are exactly the kinds of moves we unpack on this channel. But let us bring this home. Notice the through line in everything we covered. None of it is a loophole, none of it is a trick, and none of it is illegal. Every one of these exists because the tax code is designed to reward certain behaviors on purpose. Saving for retirement, building a real business, investing for the long term, taking care of your health. The government is basically telling you what it wants you to do and handing you a discount for doing it. Most people simply never read the instructions. Here is the mindset shift I want to leave you with. Stop thinking of your tax bill as a fixed number that just shows up and demands to be paid. Start thinking of it as something you can actively manage with a few smart, completely legal decisions made before the year is over. The people who pay the least tax are rarely the ones doing something sneaky. They are usually just the ones who planned ahead and used the rules that were sitting there the whole time. And remember what I said at the start. Spending a few $100s on a good CPA can easily save you thousands. A real professional pays for themselves many times over, and they will tailor all of this to your exact situation, which is the part I genuinely cannot do for you in a video. So get educated, then get help, then keep more of what you earn. If this changed the way you see your paycheck, even a little, hit subscribe so you do not miss the next one. We do this every single day, breaking down money and taxes in plain, friendly English so you always feel like the smartest person in the room when it comes to your own dollars. You work hard for your money, it is completely fair and completely legal to keep more of it. Now go put one of these to work.